Hey guys, welcome to Steph's podcast. This is episode 56, and today we have a very special guest. His name is Charles Edington. Charles and I met at the ADU Academy, right? Recently?
AU Academy.
Right. And there's a lot of people in our circle that we have in common. And if you guys have listened to my episodes or previous episodes, most of the people that I have on, I've either met personally or have been referred by a friend. So this is going to be a very good episode. And I think we'll have a great flow of conversation because we just know so many people in common. So feel like I already know Charles on a deeper level. And we've had some conversations offline. We obviously share this ADU mindset and we're in alignment with helping others with their ADU goals. So the purpose of this podcast will be a lot focusing around the financing piece of it, which is something that we're going to try. Charles and I are going to try to make this as fun as possible because nobody likes to talk about financing, but it's the key and the gateway to really help you structure some of these ADU deals and really understand how to implement the strategy. So I'll just hand the mic over to Charles. And Charles, you want to tell the people a little bit about who you are, backstory, before we get into the numbers?
Yeah, absolutely. No, happy to. Charles Edington. I am National Account Manager with Lone Star Technologies, and I'm also a licensed mortgage loan officer. Have been so for a little over 20 years. Like I said, I've been in mortgage lending for a little over 20 years, and I had a pretty traditional pathway where I was a loan officer and then got into management and have done a few other things kind of on the corporate level in the mortgage space, but have always remained licensed, have always kept those active and been working with customers to help them finance purchases and refinances and things like that. The last few years, I've really gotten into renovation and construction lending. I live in Bend, Oregon. I do most of my business in Oregon, Washington, and California. And, in doing renovation lending, working with contractors, I just started hearing about ADUs, and it seemed like every other conversation, someone was bringing up these ADUs. And, for me, an ADU was like, oh, you mean like one of those mother-in-law apartment kind of things, that people used to have over their garages. And, really just, again, started hearing more and more and more. And then I met Cole Peterson from the ADU Academy and Earth Advantage, and just, kept meeting people and getting introduced to more people, and got to know a lot of the ADU builders and just people in the space, and then realized, man, we've got these renovation loans and construction loans, and they work very often. But there has to be a better product. And so for the last few years, I've been working at Lone Star. We work directly with credit unions to try to build products to really fit the market. And I'm here to help contractors and builders, but then also help customers really just find their way to the right products. And I'm sure we'll talk about some of those products and kind of the unique features. But we've been pretty successful over the last couple of years in building out some products that have certainly have some unique features that have enabled ADU builds. And that's how I spend most of my time.
That's awesome. Well, one of the things I like is the fact that you have so much experience in the mortgage industry, right? Over 2 decades of experience. You have to have that much knowledge to understand how to structure some of these ADU loans because as you mentioned, and you hit it like right the nail on the head when you mentioned that there isn't a specific ADU product tailored for ADUs, right? Yes, we have HELOC loans, which we'll get into, and you can give us a breakdown of what that looks like because I'm assuming just like I see it here in Cali, you see it out in Oregon. Most people are financing their ADU project through a HELOC loan. If a HELOC loan doesn't work, then you got to get creative and look at other options, right? Maybe private money, maybe a second, maybe this, maybe that. But there isn't like an ADU product loan where it's like, oh, okay, you're getting ready to buy a property with the intention of building. Here's a loan that's strategically like tailored for that scenario. And
Not yet.
so,
Not
uh,
yet.
not yet. It is in the works, and like you said, it will come about. But what are some of those hacks, right, that people should consider? Like, how number one, how are people actually funding most of these ADUs that you're seeing on the back end from the financing angle?
Yeah. I mean, I would say you're absolutely right. I mean, so if you have a property, you currently own a property, you've got good credit, and you have a fair amount of equity you can tap into, existing equity in the property, then you're absolutely right. Some kind of home equity loan, whether it's a home equity line of credit, or a fixed rate second mortgage, those tend to be by far the most common loans that people are using today. If that's not available, or maybe you don't quite have enough equity today to get it done, we'll talk a little bit more about kind of one very specific HELOC product. I'll table that a little bit. But there are unsecured loans, so personal loans, that are really signature loans. The interest rates are a bit higher on those because there's no collateral; they're not tied to a property. But what I see a lot of is it's not even just one loan, for example. So they'll start with home equity, they'll tap into as much as they can, then maybe take out an additional unsecured loan to make up the difference. And then borrow some money from their uncle, or take out a 401k loan, or frankly just save up as much cash as they can, or what have you. So, the sad but true fact is that a lot of times we do kind of cobble this together, but that's where we have to get creative. Steph, you and I have talked about that there isn't necessarily one size fits all. There are definitely some things happening with the agencies, the Fannie Mae's, the Freddie Mac's, the FHA's of the world, where they're starting to adopt rules that allow for more ADU financing. But right now, I believe the last stat I saw was 87% of homeowners have a rate under 5% right now on their mortgage, and the average interest rate today for pretty clean, vanilla 20% down conventional mortgage right now is in the low to mid sevens. So I think 7.2 something was what I saw yesterday. So, if you've got a 3.5% rate, last thing you want to do is refinance your three, four, five, six, $700,000 mortgage to borrow, one, two, $300,000 to build an ADU. The juice just really isn't worth the squeeze on that. So, and that's what we see most often. And then people purchasing a home that they intend to build an ADU. We do a lot of renovation purchase loan products for them. So the FHA 203K, the Freddie Mac Choice, the Fannie Mae Homestyle, and basically those loans are purchase mortgages. You can refinance using those as well, but you can do a purchase mortgage where you include not only the money to purchase the property, but also the money to build the ADU, do a remodel, garage conversion, et cetera. You can include all of the loan. There are some caveats to that, some major stipulations of what you can and can't do, depending on which loan product. I won't spend 3 hours here going through each of those.
Yeah, and then for those types of products, getting your offer accepted is like the first hurdle, right? Because
All right.
those have been available, and I don't see a lot of opportunity around those because for the most part they won't even be considered when you're submitting an offer, and that's the other issue. So there's like so many components and a lot that you just touched on right now, which basically comes down to working with a true professional who will look at your overall assets and really analyze like, okay, where can we pull money from, right? Because a unsecured loan will not really have enough to fund the project, because now ADUs are also going up in and not only up in value, but also the price to build an ADU. And it's not going to get any cheaper, right? It's going to get much more expensive as the demand is higher, because it's just simply supply and demand. So an unsecured credit card loan for 50K isn't going to be enough to fund your garage conversion even nowadays, right? Because you can't build anything under 130,000. So you've got to, like you said, get money from here, get money from there. HELOCs, if you have a certain amount of equity, you can leverage that. Then you also touched on rates, which is so true, like even for selling, right? Because I am also a realtor, so for my real estate team, we have a lot of conversations with people who want to sell and possibly downgrade or buy something else with the intention of building, but they don't even want to consider that either, because it makes no sense to sell at anything under 5% to then go buy a downgrade option at 7%, right? Like it just doesn't make sense. and
Yeah.
and we're seeing that with the ADU as well. You touched on the HELOC. Maybe you can touch on the one that you and I were talking about, which is the HELOC with up to a certain amount after with the ARV coming into play, and maybe give them a bit more insight with that, because I think that's the one that's sort of overlooked in today's society, and people don't understand like how does that work, right? Like you're gonna lend me money based on the future value of the property. Like explain a little bit more on that.
Yeah, absolutely. So, and you kind of think about just multiple products. So we were talking about the renovation loans. Well, those renovation loans, the 203K, the choice that I mentioned, they're all in first lien position, right? So you have to do a first mortgage in order to do those loans. But those renovation loans have been around for decades, and ultimately, what all it really is you've got the current value of the property, and then you've got say a bid, and it could be for a remodel or whatever, but in this case obviously we'll talk about an ADU. You want to borrow $300,000 to build an ADU that's going to add future equity to your property. Renovation loans take that future equity into account. So let's just say your property is worth $800,000 a day. It's going to be worth 1.1 million once the construction is complete. On a renovation loan, you can borrow against, again, that future equity and borrow usually significantly more money on those loan products. But those are all in first lien position. HELOCs, home equity loans, those are all in second lien. You can do it in first lien position, but HELOCs are in second lien position, and they allow you to borrow against the current equity. Well, now there's a renovation HELOC, and we use it specifically for ADUs, where you can take out a second mortgage, a second lien position line of credit based on the future value. So, again, you don't have to refinance, and you can borrow funds based on the future value. And the nice thing about home equity lines of credit is that in most cases, and certainly on the loans that we offer, there's a 10-year interest-only draw period where you can draw the funds. And so even if you close the loan today, let's just say, you've got a couple of months for permits, and you got a couple more months for excavation, and whatever else, construction takes a few months. It could easily be 6 to 12 months before from concept to moving a renter in, right? And so being able to borrow along the way and only pay interest on the amount that you've borrowed is a really nice feature of these products. And you can make interest only payments on that, and you can do that for roughly 10 years on these programs. So especially if you're renting out for cash flow purposes, and you're really trying to max that out, you can put money towards principal if you like, but you don't have to, and that's really the beauty. And the way the loans work, just to give you kind of some numbers on it. So we allow you to borrow up to 90% of the future value of the property, up to 150% of the current value of the property. And so it's really the lesser of those two numbers is what you're allowed to borrow. We can do loan amounts all the way up to 500,000, depending on how far up you go. That does kind of scale back where, if you're really kind of redlining it and borrowing every penny, sometimes the maximum loan amount will come down a little bit. And of course, you got.
And if somebody was interested in this one, right? Like, let's say you have a property, you have some equity, and you're thinking of building an ADU, how do you determine the ARV so that you know how much you can lend, right?
Yeah, that's a great question. So on these loans, we do a dual appraisal. And so in addition to the customer qualifying from a credit and debt to income ratio standpoint, there's a whole renovation underwriting team. We work with a third party to do that. And they're doing a full feasibility study. They're underwriting, they're looking at plans, bids, specs, and really analyzing that bid from the contractor, looking at drawings and things like that to really put a whole package together to then ask an appraiser to come out and say, hey, what's the property worth today? From a comparable standpoint, what's out there, come up with a value of this home based on like properties for the current value, and then go out there and find us some more properties, some comparable sales that have had ADUs, that are similar to this, and basically let us know how much equity, what's the after renovation value or after construction value once this project has been completed. And it's up to the appraiser to go out and say, okay, here's the existing home. I've got all these drawings, plans, bid, specs. I have a really good concept of what this is going to look like after the fact. And so then I'm going to go out there and find additional comparable sales, put together an appraisal, and figure out the future value. And so we lend, again, that's why we're able to do calculations each way. Sometimes people have a pretty good chunk of current equity and they just need a little bit more. And so the current value doesn't really come into account that much. But someone who's recently purchased with an FHA or a VA loan, they put nothing down or 3.5% down, they don't have a ton of current equity. They really need the
That's
ability
a good
to
option for them.
go up higher. Yeah. Mm-hmm.
And the fact that you have that 10-year interest rate option is really good because most of these ADU projects are going to take 8 to 12 months to build, and half of that waiting time is really waiting for the permits and going through the motion of the planning phase. So a lot of time is kind of just staying still there. You can't do much, and so being able to have the funds available but not really have to use them, and then only pay based on what you're using. That's also like another benefit, I think, of going with the HELOC option. Now let's assume that that there aren't enough, I don't know, like comps in the area or enough data for an appraiser to come out and say, hey, this is what the ARV is going to be after the fact. And for whatever reason, that HELOC option isn't an option for them. What's another way that people are sort of funding these projects for these
Yeah.
ADUs?
Yeah, I mean that's almost always, especially if they don't quite have enough current equity, that's always going to be plan A, and
Mhm.
usually it's going to be kind of like plan A1 is okay. The good news is I know you wanted 300,000. Um,
Right.
the bad news is I can't give you 300,000, but the good news is I can give you 260,000 on this product. And if they've got the ability to qualify for additional financing, so we often stacking would be a term where you basically help people get multiple loans. So we might stack an unsecured loan on top of that. So hey, you qualify for 260,000, but unfortunately, again, if it's a credit or a debt to income ratio standpoint, well, that then that turns into a different conversation. But if it's truly, man, we got you every penny of equity we possibly could borrow against, and they're still a little short. Again, we might stack an unsecured loan on that, or again, we might coach someone to just say like, hey, you might, depending on your why, we always start with why, and we want to anchor people back to like, what are you, what's the real purpose of this? Is it a financial gain? Is it a family thing? Is it future proofing, et cetera? Helping them decide really, kind of put it on
Maybe they
the
just build
game.
based off of 260, right? Maybe
Right.
like
Mhm.
their first initial, it happens all the time where I have clients that, especially investor clients that want to do it for rental purposes. Many times they think that like building highest and best use and maximizing 1,200 square feet is going to get them the most amount of rent. And what we've found, at least in SoCal, is you don't need a 3 bedroom, 2 bath to maximize rents. A lot of millennials and a lot of people, travel nurses, different avatars are actually downsizing and they don't necessarily need a big space. So a lot of these renters, you can actually cash flow a pretty good amount with just a simple 2 bedroom, 2 bath under 750 square feet. And
Mhm.
many times if you stay under that 750 square foot mark, you avoid a lot of these impact fees. You
Mhm.
stay within budget and you're able to cash flow versus you having a 3 bed, 2 bath, 1,200 square feet because you think that's what's out there. On top of that, most of the comps support that. There's a lot of ADUs here in SoCal that are between 4 to 600 square feet. So you're not seeing a whole lot of big builds, at 1,200 square feet. And so going with what data is there and using that to your advantage is always key. So I think it goes back to working with true professionals that are going to be there to guide you. Like, hey, you don't qualify for the 300,000 that you were expecting to build the biggest ADU, but you do qualify for 260. So why don't we revisit this idea? If it's for rental, maybe let's consider building a 2 bedroom, 2 bath, which you could essentially build for under 260, in places like SoCal still.
Yeah,
So
and
yeah.
we definitely spend time with the customer up front. Not only talking about their qualification and doing all the things that you would do on any other loan. We also work a lot with the contractor, and again, so at Lone Star, we offer a lot of our loan programs through the contractor to the customer, which
Mhm.
allows it to be seamless. We kind of frankly cut out the middleman in a lot of ways, so these loan programs are less expensive, et cetera. Um, And really, there is a lot of upfront conversation. I don't think there is a very similar to purchasing a home and getting pre-approved, right? There's not a time that's too early. I work with people 2 and 3 years before they're looking to build an ADU pretty regularly, and a lot of times it's very similar to just that pre-approval. What can I do? I'm conceptualizing. I'm probably a year away from being able to do whatever it is I think I want to do here, but gaining that peace of mind. And then once they select a contractor, once they've got a preliminary bid and they've got some drawings, et cetera, again, that's when we'll start looking at the market as a whole. And we're going to be reliant upon that appraiser to come up with the comps and all that for the official appraisal. But nothing's stopping us from, for example, working with a realtor like yourself, Steph, to go out and say, hey, what comps do you see? What if you were going to list this house today with this ADU, what might you sell it for?
Right.
And just trying to do our own preliminary market research to just understand, hey, yeah, I know I love your design. I love your design. It's great, but you're kind of overbuilding for what you're doing there.
That area, right?
Kind of
Or what
a
you're
little
doing.
bit there, right? So again, it's a very iterative process, working with not only the customer but also working with the contractor and any other stakeholder. Especially, Steph, if it's a purchase and build an ADU, kind of like the quote unquote ADU play, right?
Mm-hmm.
We got to make sure that, and so a lot of times, and so you mentioned people aren't getting their offer accepted with a renovation loan, right? So
Right.
I rarely do renovation loan purchases now, when that used to be the default even 4 or 5 years ago. So now I might take that customer who qualified for an FHA 203K renovation loan and say, hey, let's not try to, or we can try to go in with that on the offer. Why don't we just go in and you just purchase the property with a regular old loan, conventional FHA, VA, jumbo, whatever, and then let's go ahead and pre-approve you for that renovation HELOC, and just so we're certain, we can give you the confidence and the certainty to know that, okay, it's a day after closing, now let's start talking about the second mortgage product, and we don't have to convince a listing agent that this renovation loan is going to be.
That's probably the biggest hack you dropped on this episode. If anybody takes anything away, those last 30 seconds were it. Even for me, right? I think a lot of realtors who listen to this podcast, or investors, or anybody who listens to it, they're wanting to get an idea and strategies and hacks around it. And he just literally dropped one right now, which is, if you are looking to buy with the intention of building, it's so difficult to get financing. But if you do it the way that he structured it for you just now, that's the way to go. So you buy a property like you would, and you were planning to, whether it's FHA with 3.5% down, or conventional 3%, 5%, 10%, whichever option. But you have those two options to buy. Once you buy it, then you do the HELOC renovation loan based on the future value of what you're thinking of building.
Mhm.
And that is one way to tap into the ADU play. Really, like that's
We do it
it.
all along.
Especially for those buyers, who are wanting to buy with the intention of building. Now, the people who currently own, you have a little bit more leeway and available, like different options available to you, because you have leverage, right? You have an asset that you can leverage in many different ways if you have the equity. So I think, especially for those people who want to buy and tap into this market, you have to have that investor hat on already, because even as a first time home buyer, you have to think of ways on how you're going to offset your mortgage, right? Because that's like the first hurdle. Everybody's wanting to buy right now, but they look at your average payment here in SoCal. It's like 4,500, 5,500. How can you offset that mortgage? And that's going to have to be with looking at things like this, like the HELOC renovation loan, where you are buying a property, it's your first house, but you're thinking of, okay, I'm going to buy this first house, I'm going to live in the front, I'm going to convert the garage, and I'm going to rent it out for 2,000, 2,500, so that it helps me with my $5,000 average mortgage payment in SoCal, right? And that's really like the mindset that you have to come in with in this type of market in order for it to work. I think in any market, there's ways to pivot, and there's different strategies, and this is one, right, that we just mentioned. So I think if people wanted to connect with you and have a conversation and set up a roadmap, on the financial side of things, they can reach out to you through Instagram, or I think I'll add your contact info in the podcast link. But before we wrap up, I did have one other question. So you're in Oregon, and
Mhm.
Oregon has really pioneered a lot of the ADU movement. Actually, Cole Peterson, who organizes the ADU Academy, who I was, fortunate to be a part of it and teach the real estate course for it. He is from Portland, Oregon,
Mhm.
right? And that's where he built his first ADU. So I know ADUs are a big thing out there. What are some of like the trends that you see out in Portland as far as like building types? Why are people building? Give us some case studies there that you can share just to inspire people and give them ideas of, okay, this is what people are doing, this
Mhm.
is how they're going about it.
Yeah, and it's interesting to kind of follow along from Oregon, because you're right. We pioneered in many ways, but other states have kind of taken what we've done and really ramped them up. I mean, as a member of the Casita Coalition, and just seeing all the different things going on in California, you can really get into the weeds on, well, this bill allows for this and that. But
Hmm.
I would say, kind of looking at what has already happened, most specifically in the Portland metro area, and kind of as what's coming next, so to speak. I would say, we're starting to see more. So like lot splits, people wanting to split their lot, maybe purchase a home with an oversized lot, build an ADU on it, split it. Being able to do like SB9, for example, selling off the back units, so basically selling your backyard, right, has become certainly a trend. I'll tell you another trend, and AB 1033 in California allows for, and we're still a ways away from implementing, specifically because
Right.
cities have to adopt, but at some point in the future, in some cities, probably not all. I'm talking to you, Malibu.
Well, Santa Monica's raised their hand. I think they're one of the few cities or only cities that I've heard that are opting in for the AB 1033, which I wanted to get your take on it from a lender standpoint, right? We don't know what it's going to look like yet. And I had a call from a realtor earlier who called me asking me questions about AB 1033, saying, hey, I have a client who wants to build in this city. Do you know what the process looks like? And I'm like, I don't know, and I don't think anybody does yet, because we don't know what does the CCNRs and the rules and regs look like for a two people HOA.
Yeah.
you know we don't know what that's going to look like, and it's probably going to be city specific based on the cities that opt in. So there's so much that has to happen there, and I don't know what the process will look like and how long it'll take to streamline that with each city who does opt in for AB 1033. But from a lender standpoint, what is that going to like look like, when in the future, let's say Long Beach, for example, because I see
Mhm.
Long Beach being one of the few cities in SoCal that opts in, because Long Beach is very ADU friendly. I think they're even rolling out with the financing option for Long Beach residents
Mhm.
to help them with their ADU project.
Yeah.
So if, let's say, a city like Long Beach was to opt into AB 1033, from a lender standpoint, how does the underwriting take place there?
Yeah. So, and there are a couple things to go with that. So condoization. So yeah, AB 1033. I don't think I ever said it out loud, but AB
Right.
1033 should allow you to build an ADU and then call that a separate condo unit, right? So you have essentially, like you said, a two-unit condo complex. So it's a small
Mhm.
condo. So there are really a couple things. So if you want to, if you're going to do the split, there will be, and I try to stay in my own lane here. I'm not a tax attorney, not a real estate attorney, et cetera. So if you want to create a condo, I'm sure the attorneys are going to be sitting there waiting to help you out with that, right? So you'd create the condo, or at least begin creating the condo, and then the whoever's purchasing your ADU effectively as a condo, um, for small condo units, Fannie Mae and Freddie Mac, who handle conventional loans. FHA will kind of see what adoptions are there, VA, because they have specific condo requirements as well. If you have a small enough condo complex, you get around a lot of the condo rules. So condos, So some rules for condos, usually no more than 50% of the units can be owned by an individual. Well, guess what? You're going to have 50%. It's either going to be 50% or 100% are owned by one individual, right? So you obviously can't apply that. So there are some other requirements that I won't bore you with for condos that don't apply for small condo units. The tricky thing, and so again, a customer should be able to, once the condo unit is created and you've got a legal condo, a customer should be able to come in and take out a very normal vanilla loan product to be able to purchase that condo. So it's absolutely going to enable a small shadow market for now, but hopefully in the future it grows and grows, of actual affordable homes that people can buy, which is something that the majority of California hasn't seen for quite a long time. I'd say the majority of the U.S. hasn't seen for quite a long time.
Right.
But the tricky part is, say you own a property and you have a mortgage on it, right? And let's say you own $1 million property, you've got a mortgage for $600,000. Well, that $600,000 mortgage is tied to the entire property, right? And so if you're going to split off a parcel and create a condo unit, it's really not a parcel, but you're going to split off and create a second housing unit, or a second dwelling is the right term. Then you've got to go back to the lender who has a loan on the whole thing and say, hey, by the way, that is no longer, the rest of this property, you no longer have a security interest in that. So that's going to be separate. And so you got to go to the lender and say, can we do, what effectively is a partial lien release, et cetera, to where, hey, we need to draw it up where now, Wells Fargo, for example, you don't own unit B, or you can't foreclose on unit B if I stop making payments on unit A, basically. And so, usually if you've got enough equity, it's not going to be a problem. You can call up the bank, let them know what you're looking to do. They'll probably just recalculate, okay, so now it's not $600,000 on $1 million property, it's $600,000 on an $800,000 property. And we're okay with that. The problem is going to be, it's $600,000 on a $700,000 property. Actually, no, it's $600,000 on a $500,000 property. No bueno, right? That's not going to get by the lender. And so
that's why I think this is all going to take some time. I know, is it Washington? I think in Seattle, they're kind of doing something similar already, but I'm sure we'll adopt, some of what they're doing. But this is going to take a while. It's going to take at least a year for the cities to get together and really come up with a streamlined process, and then see what HOAs are going to look like and see what the lender requirements are going to be like. But yeah, super insightful from it coming from you with so many years of experience, and we'll see what that looks like. But I think it's great for people to start educating themselves about it and know that it's out there and it's an option. And once it does happen and we have a more structured process with AB 1033, I believe ADUs are going to skyrocket and they're going to be much more expensive, right? Because now you can sell them off. Now, it's like profit 10x. So and then now they're really going to get the value that they deserve, right? Because many times appraisers don't give it the value that they deserve, but now being that they can condoize them and it could be its own separate unit independently from the main property, it's going to create a lot of value, which is going to create a lot of demand, which is going to drive up costs. So if you guys are having thoughts of building, the first step is what I tell all of my clients who want to buy is first sit with the lender and figure out how much you can fund, right, for your ADU project. So the same way that you talk to a lender to figure out how much you can buy and figure out your purchase power, you got to do the same thing with an ADU project. So if you're having thoughts of building one, reach out to Charles, have a consultation with him. I'll include his detailed information on this podcast episode. And feel free to reach out, whether it's in California or other states. I have listeners who are in different states. Just reach out to him and start off with the financing, get those numbers squared away, and then reverse engineer and build based on what you can afford, based on, integrating like everything else, why you're building it, what your time frame's like, what's the future use of it going to be. Taking all those things into consideration will really help you just have a smooth process, hopefully.
Yeah, Steph. One thing you said investors a few times, and I also want to point out, because I was really kind of had my residential hat on there for a minute. But so take like San Diego County obviously has some interesting allowances, and so I
Hmm.
work with a lot of investors who are coming in. They're buying a property, and they're putting 4, 5, 6 ADUs on it. There that once you get above, so right now, again, I won't bore you the details, but the agencies, the conventional, the Fannie Mae's and the Freddie Macs, they have restrictions on how many ADUs you can build, or
Right.
on what properties you can build an ADU. So, for example, Freddie Mac, if you have a duplex, you could build one more ADU and have a triplex. If you have a triplex, you could build one more ADU and have a fourplex. But if you've got a fourplex or you've got a duplex with 2 ADUs, you cannot build another ADU because you'll have a fifth unit, and 4 is the absolute maximum of units on a residential property as far as that's concerned. So a lot of people, a lot of investors are coming in and realizing, man, like I can really maximize my ROI on this property by adding, do this garage conversion. Here's an addition JADU, do 2 more detached ADUs in the backyard, build a detached garage and throw an ADU or 2 on top of that, right? I mean, we see some really unique stuff happening, which is so cool to watch and be a part of. But that's where really kind of the private money, the commercial side of the business kicks in. And, those loans, even if you purchase just with a regular conventional, like you buy an investment property, maybe it's your first or second investment property, you're able to put 20% down and get a conventional loan. You can come back and do a commercial construction loan on that, and usually build up to 6 units on those. There are exceptions that go up above. There are a lot of private lenders who will do anything and everything for the right price, right?
Right.
But there are absolutely commercial type construction loans for investors out there with very flexible terms, interest only during the construction period, no payments sometimes during construction. And so, yeah, those loan products are available as well.
Yeah, that's a good point. Anything above 5 units, especially in San Diego. I mean, like you said, San Diego has this density bonus rule, which is only in San Diego. So a lot of people are buying properties and building, like, I kid you not, 10, 20, 30 ADUs on a single lot because of this bonus rule, which basically, depending on the zoning type, it allows you to build so many ADUs. And that's only in San Diego. But even in SoCal, like LA, Orange County, we do have a couple multifamily bills that are passing and are making it much more friendlier to where you can build 2 or 3 or 4, depending on the zoning type. So anything above 5 units, like you said, private money is the play at that point, and learning how to structure that, which is very similar to the HELOC renovation loan. The contractor has to provide everything that the underwriter will need in order to justify whether this project is going to be worth it or not, and in lending you. So, good
Yeah,
points.
those loans, just real quick, those loans were really different than, so say on the renovation HELOC, especially if you're an owner occupant, we're underwriting the customer, right? And there's
Mhm.
obviously a
Right.
customer needs to have all the things that we require for all the compliance regulations, ability to repay, et cetera. So, we're really underwriting the customer. And then obviously we're underwriting the renovation and construction product, the ADU build as well. On those construction, like commercial loans, we're underwriting the construction. It's not about what your credit look like, what's your debt to income ratio. It's what's it worth today? What do you want to do? What's it going to be worth after the fact? And then so things like debt service coverage ratio. If we build these, what's the likely rent? Does that cover the financing? Things like that. That
Yeah,
really
you're
comes
looking at
into
the
play.
building really as a whole and what that building is going to produce, and that
Mhm.
qualifies itself. Yeah,
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 it's
that's
more
a
like
big
a business
factor.
loan that way. We're really looking
Right.
at the final constructed home and ADUs as a business. Yeah, does it cash flow? Can we
Right.
expect the cash that comes from this to pay the payment?
I agree. Yeah, no, that's a good point. So definitely looking at it from a business standpoint, which you should be, honestly. You should be, if you're doing more than 5 units or buying or whatever, you already have them and you're looking at how to maximize highest and best use. You should be looking at it as a business and how it operates, and kind of determine whether it's a good business move or not. So,
Absolutely,
yeah.
absolutely. I've seen a lot of I've seen a lot of lame brain schemes that really sounded good in someone's head, and then we put it on paper and like, oh, I'm going to lose
Right.
$500 a month if I do that. So I'm probably not going to. Yeah.
Yeah, and one quick way, and I'm having a webinar with Homeplex later this month where we're going to teach people who want to become a ADU advisor or want to become a referral agent. If you guys want to join that, feel free to reach out. I think Charles joined our last one where we talked and really gave a breakdown of how we help clients through this whole entire process. So whether you're looking to build 5, 10, 20 units, we can help you analyze your portfolio and see if this is going to be a good option or not. But even at a very basic level, like we'll look at, what does your current mortgage look like right now? What is that second mortgage going to look like once you finance the ADU? What can you rent that ADU for? And then what is like the remaining balance, right? What are you cash flowing at the end of the day? Does it make sense? How long will it take you to pay off the ADU? 10 years, 15 years down the line? What is that? What do all these projections look like? And so we kind of help you analyze every single angle and create like an ROI comparison so to help you determine these things. And it's very simple but not easy to do. So that's why we're here as advisors, and that's what we're going to be talking about. I think it's on the 30th now. We pushed it out to April 30th at noon. So if you guys want details on that, let me know. Again, thank you so much, Charles, for being on. You were super informative, and I hope that people reach out to you for those who have, intentions of building and growing their portfolio this year.
Yeah. Thanks. Glad to be here. I'm never gonna miss an opportunity to talk about ADU financing. So yeah,
Yeah,
thanks.
yeah.
As always, I appreciate it.
Same here. I appreciate you, and thank you for being part of the ADU community. All right, guys, that's it for today. Thank you so much. I'll see you guys on the next one.